Hey there. Thank you for clicking on the link and taking the first step in your possible journey to home ownership. I'm Ron Evans with Century 21 Award, and this is Ryan Broughton, one of my lenders. Ryan, can you tell me a little bit about yourself?
Yep, Ryan Broughton here with Cross Country Mortgage. Been working with Ron for a while and happy to be part of this video, give you a little feedback on available loan products in the market. Maybe some insight on things that you don't know in regards to different products to get into the market.
Okay, yeah. So sit back, relax, enjoy this video. We're going to hit a lot of topics on helping you going from renting to owning. So the first thing I kind of want to talk about is reasons that you're renting. Maybe you're renting by choice, but most likely you're renting because there's a reason, there's a backstory. And we're here to try to figure out that backstory with you and come up with solutions for you. So maybe you're renting because you think you can't afford to buy. I know affordability here in Orange County is a big issue. Would you agree, Ryan?
Absolutely.
Yeah. We're one of the top 5 markets in the country to try to buy a house in, and it can be a daunting task. But I could tell you from my own personal experience, you might be renting a condo here somewhere in Orange County, 2 bedrooms or so, and you're paying about $2,200–$2,300 a month. And we're going to talk about in a little bit, but I know that there's programs out there that you can put very little down, and your mortgage payment would be right in line with what you're renting. Right?
Oh, absolutely. Absolutely. I mean, rents have been on the rise. I mean, they're the highest they've probably ever been in our country, and they're continuing to go up on average, I think 3.5% to 4%.
Right.
Probably higher in a market like this where there's just more demand, and it's just a simple supply and demand. You know? And so rents continue to rise, and it's very easy to typically kind of reverse engineer qualifying a client to get them to a payment that's comfortable or in alignment with the rents they're paying. Another thing that we've been seeing a lot of is buyers carrying high interest debt, and the payments on $10,000 of high interest debt, let's call it $250 or $300 a month. In a mortgage, that could equate to $25–50 a month. So sometimes leveraging available money for a down payment and going with a smaller down payment loan and utilizing some money that folks have saved in advance to pay down some of that high interest debt will allow them to step up on the payment a little more comfortably. Okay. So I think it's super important that we look at everything that exists for the client and try to come up with a strategy that's going to make sense to them. And then to touch on the first topic, there is quite a few 100% finance options out there through down payment assistance programs. Not necessarily just for first-time home buyers anymore, but first-time home buyers definitely have a hand up with the programs. So we have products that we can get 3.5% to 5% free, non-recoverable down payment assistance. The income limits in Orange County are actually pretty high, so household income can't exceed on one of the programs $174,000, on a different program down payment assistance $184,000. So it really opens up the window, and we've been seeing quite a bit more of this lately, where we can do again 3.5% grant money, it's non-recoverable, up to 5% for the down payment, and then literally 3 to 4% in closing cost credits for folks.
Wow.
There's some differences in the program, so you really want to talk to somebody that's licensed and educated and understands the programs, because some of them are recoverable, subordinate liens, some are not. So it's a matter of just looking at your options. But on the traditional mortgage side, FHA is a wonderful entry-level product. It's a minimum down payment at 3.5%. If you go with a conforming loan product and stay in a conforming loan limit, you can put as little as 3% down. So the whole idea of 20% down being required, I think, is a big misconception that's often out there in the market when I talk to clients.
Okay, thank you. So another reason that you could be renting, other than possible affordability issues, is maybe you've got a past. We all have a past of some sort. It's not always rosy. And real topics. Several years ago, we went through a huge financial crisis in our country, and it impacted the real estate industry more than anything else. People with short sales, bankruptcies, foreclosures, and I know from my own personal experience, it's extremely daunting, and you may even have like a mental block of, I can't go through that again, because there's no help for me. So touch a little bit on, if someone has had any issues, because again, it's very prevalent, people that have had issues in the past, of what we might be able to do to help them.
Right, yeah, I mean, we run into it often. We're, really probably 11 years since the last little meltdown, and the recovery's been phenomenal, but there is still quite a few clients we meet that had a strategic short sale, where they just had to make a decision. Foreclosures, bankruptcies are common that we see, and so the waiting periods are different on all loan products. They're not as bad as a lot of folks think. I mean, we have products that you can be 1 day out of a foreclosure, 1 day out of a bankruptcy, and we can fund a loan for you. The programs are a little different, they require a little more down and additional reserves, but from a traditional loan standpoint, a conventional loan requires on a short sale, for instance, a 4-year waiting period from the time of short sale, and then you're eligible again for conventional financing. All the normal product, FHA requires 3 years, VA requires 2 years, and a USDA loan, which we don't see much in our market, requires 2 years as well. Foreclosures tend to take a longer time to get behind you, so 7 years waiting periods required with conventional loans, 3-year waiting period with FHA, and with the VA, I believe it's 3 years as well, but don't quote me on that, call me and I'll verify it.
Right, thanks. So let's talk about the different types of lenders that are out there. You have your traditional big banks like your B of A's or Wells Fargo's, you have your direct lenders like you, and you've got your mortgage brokers. And let's talk a little bit about what to expect from those types of people, or those types of channels. I know for me, when I look at something like the way I was raised, my parents always wanted to deal with Bank of America because they had a relationship with Bank of America.
Right.
They would walk into their branch and that same guy was there for 30 years.
Knew the
right?
teller, yeah.
Knew the teller, you knew the loan officer, you knew everybody, you knew the branch manager. They didn't float around, they didn't move. And I still run into clients today that have that mentality because that's just how they were raised. And I'm not saying it's right or it's wrong, but I think today the converse is actually more prevalent, to where if you're dealing with someone who is at a Bank of America or more of the traditional bigger ones, you may not know who it is and you may not have that relationship. You think you do, but you truly don't. Or dealing with smaller private money guys like you're always around and you're giving that kind of service that they would have expected years ago from their big banks.
Right.
So touch a little bit on that with what you see, and am I on the right path?
Yeah, no, absolutely. And I think, banking has definitely changed. I mean, we're seeing it, and it's going to continue to change. The notion of going in, like when I was younger, we knew the teller, I knew everybody at
Right.
the bank, and there was less banks, brokers, and retail lenders, direct lenders like us in the mortgage space, and quite frankly. But the idea that you're going to get a better deal going through the bank you bank with, unless you have $1 million parked in Merrill Lynch.
Right.
In that case, yes, Bank of America will give you wonderful discounts on rates because they want you to keep your money there.
Right.
You got to realize the big banks, their revenue is not huge off of the mortgage divisions. They make way more money off of their savings accounts, reinvesting that, paying a client 0.5% on a savings account, but making it a 7.5% return in their investments with those savings in the bank. Credit cards, everything else that they can cross promote. So I don't think they, in most cases, do the best job they can do on mortgage lending, simply because it is not 100% their focus.
And they've, to your point, since what we've had happen there in the mid 2000s and all the different regulations that have hit, they've also peeled back their risk taking.
Oh, absolutely.
Up until that point, they would probably give like the lowest rate always and sign anybody up. But now with all the different things that have gone on, they're not willing to take as much risk.
So the big banks, yes, to kind of just go back, the notion, I get it a lot from clients that, I bank with Wells Fargo or Bank of America or Chase or whoever it is.
Yeah.
They're going to take care of me because they take good care of their clients. They're going to give me a better deal. And the reality is they're securing the loan in a secondary market no different than all these other channels of business. It's just how it gets secured and who's in between them and that market. So you're starting from fresh. You're still an applicant, just like the guy that doesn't bank with them and walks in and says, I want to qualify for a home loan. You got to qualify. You got to meet all the requirements of the loan products. So there's nothing different that they're going to be able to do necessarily. I think, you know, the broker channel to go back, so the big banks, you know, they do follow closely qualified mortgage rules, which is all part of the Dodd-Frank. They will not deviate from that simply because if there was ever an issue again, they want to know that the government has their back and would bail them out. And that is what we call QM lending. Now there's a whole nother world out there called non-QM lending, and the big banks will not touch those types of products. These are people that maybe don't fit in the perfect box. The self-employed individual that's not claiming enough income on their tax returns. There's bank statement programs for them with very aggressive and comparable rates.
And that's huge here in an area like Orange County where we have tons of entrepreneurs and self-employed.
Absolutely.
Right, self-employed businesses are just, I think we're probably one of the highest percentages of that in the country.
Absolutely, and these non-QM loans, so the difference, you know, again, it's very limiting. They have a box, so if you don't fit, whether it's a conventional loan, a jumbo loan, they limit you to a 43% debt ratio, where I can go to 50% with a lot of my jumbo product, right? 55 in certain cases. So the problem is when people go in and they try to qualify sometimes with the big bank, if they don't fit in their box and they don't qualify, now they got to go to the next big bank, and it delays the process. It's frustrating. You're getting misdirected.
So regardless of the relationship, if you don't have a ton of money there, you're still just another number.
Yeah,
You're just someone else off the street. It's
and even with a ton of money,
the guy's not going to be like trying to pull any strings for you.
No, and the lending guidelines and the regulation has gotten so tight that even the guy with $10 million in a Bank of America account, if he doesn't meet the guidelines, they're not going to be able to qualify him. You know, it's as simple as that. So where I differentiate myself from the big banks is I have all the big bank jumbo product. From a conventional standpoint, entry-level homes typically don't require any type of non-conforming. Maybe here in Southern California, but usually we're talking conventional or conforming loans, so it's the same thing. FHA or VA, you know, entry-level loan product for the normal blue-collar family, right? And that stuff, you know, their guidelines, they do overlay, you know, so they're not offering exactly what Fannie and Freddie say they're willing to lend on.
Right.
So it's limiting, but on the jumbo side or non-conforming loans, again, I differentiate myself simply because if I have a client that doesn't fit in a Wells Fargo product that we offer, we have a correspondent account with Wells Fargo. We underwrite and fund their loans in-house, and then we sell those loans to them in the secondary market, and they take over servicing post-closing. So if my client doesn't fit in the Wells Fargo bucket because their guidelines on non-conforming are different from every bank, unlike Fannie and Freddie guidelines that are the same for everybody unless you decide as a lender overlay your own guidelines on top of them, I can then look at a Chase product for my client. Maybe he doesn't fit in the Chase, so we got to look at an AIG product or a Redwood Trust. So we have, in the retail lending platform, you typically have 15 to 25 different jumbo investors. And within those pools, they have product suites where they're going to have various different types of products, some of which are non-QM type of loans that the big banks simply don't do. So I think dealing with a direct lender versus the big bank has its advantage simply because there's more options.
Okay.
And we're focused 100% on mortgage lending. So as cross-country mortgage, we do about $10 billion a year in residential financing. We're in all 50 states. That's all we do. We don't sell credit cards. We don't have a brick and mortar checking and savings type of strategy. I mean, it's mortgage banking. It's not banking, right? So our focus 100% is to give the best service, have the best turn times, have very competitive rates, and have a product suite that we can house just about any borrower that's going to get financed out there and have a solution for them. The broker channel, I was in it for a long time. It's great for certain things. They have a lot of the diversity that somebody in my lane would have as well, where they're set up with numerous banks to broker products to them. The downside, especially with purchase lending, and part of the reason I'm not still in that realm, is service levels.
Right.
You know, brokers get low rates because they have very low overhead, but low overhead typically equals less service, less control. Traditionally, brokers would mail a borrower's package, literally mail it to the wholesale lender that would then process it, underwrite it, and fund it. And now you're just one broker of thousands that are sending to these banks, and it typically works that way because whoever's offering the most competitive wholesale rates is where the brokers send their stuff to. And so they may get, you know, an influx of submissions, and now they're at a 2-3 week turn time. You lose a lot of control. Whereas we can allocate in my office priority files. I can walk down and talk to my underwriter and troubleshoot on a challenging file. Just a different level of resources, you know, and doing everything in-house. I mean, we process the loan, goes to underwriting, my underwriter's right there, we have full control over how much we're allocating to them, so we don't, you know, overdo our underwriters, and they can, you know, meet our 24-hour turn times in underwriting. And then we have the funding department, so it just gives you a lot of control that you don't have in the broker channel. And a lot of brokers will try to call themselves direct lenders because they have credit lines, essentially, closer relationships with some of the wholesale lenders, which does give them some advantage in how they have to disclose their fees to the consumer, and it gives them the ability to make a little more money on the transactions. But it's a big misconception because 9 out of 10 of those types of broker, direct lender type of folks, they're not underwriting the loans in-house. They're not making the decision. The wholesale lender's still making the decision, underwriting the loans. You're at the mercy of their turn times. They're funding the loans. It's just a different type of contract or agreement that they have when you're a correspondent broker versus just a wholesale broker. So again, a lot of product options there. I think from a purchase standpoint, from a refi, if you can wait 45, 60 days for a loan, broker channel is not a terrible place, you know, to go. But again, sometimes you get what you pay for.
Sure.
Right. So our rates tend to be maybe a hair higher than the broker channel in certain cases, not always. But I have so much product as a, you know, a well-funded company that, you know, brokers can't get delegation with Wells Fargo. Matter of fact, Wells Fargo doesn't even do any wholesale, haven't since the meltdown. Very little. I mean, it's correspondent lending and very tight relationships that they only set up with banks that are well funded. You know, so it can be a little limiting. I mean, I hope that's helpful.
Yeah, perfect. Thank you. So, pre-qualification of a loan versus pre-approval of a loan is what I want to talk about now. From my standpoint as a realtor, I get clients all the time, and when I talk to them at an open house or however I pick them up as a buyer, I ask them, hey, have you been approved for your loan? Yeah, I've got my qualification letter right here. But when I look at that qualification letter, it's just that it's a qualification letter. And my viewpoint of that is it's not as strong as a full approval because it means they haven't actually turned in any documents to their lender. They just probably had a phone call, and based on them giving true and accurate information to the guy on the other end of the line that's typing everything in, he's saying, if all this stuff is true and accurate, we can approve you, or we can qualify you for X amount, right? And at the bottom of that letter, there's like 35 conditions listed there that you've got to meet to fund a loan.
Right.
Now, let's converse that with an approval letter that I will see occasionally, and usually I'll get the approval letter after I've recommended my lender to somebody. And the approval letter I get says, we have looked at everything, you've submitted documents, and this is a true approval based on, you might only have 1 or 2 conditions to meet, and that might be the sale of a home, or you know, updated bank statements at the time of closing or whatnot, because it's good for so many days, right? Yeah. To me, it's like the difference of walking in with monopoly money versus real money when you're making an offer.
Absolutely. Yeah. So there is a lot of misconception on what the difference between pre-qualification and pre-approval, and then I'll add another one in there: credit approval. That's a big thing that's happening now, and we're doing it. Other banks, you know, are doing it as well, and it's just taking that pre-approval step further. So pre-qual, exactly what you said. It's no verification of income, assets, or even credit. Typically, it's 5-6 questions that you're, you know, answering to a loan officer, and it's all consumer assessed. So if you think your credit's excellent, and it turns out it's 680, and you thought that was excellent, that could affect your ability to qualify or the rate you qualify for. You know, if you just are throwing numbers and income out there, it's just so loose. You know, none of the information is verified, so it holds very little weight. and agents know when they see a pre-qualification that the consumer is barely taking any steps with the lender, broker, bank, whoever's doing it. A pre-approval is your income has been reviewed by a loan officer. Again, you hope the loan officer knows how to properly calculate income and where to look for things that could bring income down, whether it's 2106 expenses or Schedule C loss, or so pre-approval does take it a step further, where they're reviewing your income, your assets, your credit, and doing a full application. And typically on a conventional loan or an FHA loan, they're going to run it through an automated underwriting system. Now, I see it all the time where we look at those, what we call DU findings. It's Fannie Mae system. Agents ask for that proof a lot along with the pre-approval letter, so they know you've taken that step. And so in doing cross qualifications for agents that we work with, often I'll look at the DU findings, and they had already looked at it before, and they go, hey, the automated underwriting, these DU findings he's approved and everything looks good, but the information it spits out is only as good as the information that you put in. And that's why loans have to go through underwriting, because not all loan officers and processors are aces at calculating income. Maybe they're missing certain guidelines, or maybe guidelines changed and they haven't ran into it and weren't aware of it. So having to go through underwriting is super important. For years, nobody had the bandwidth to send loans through underwriting prior to somebody being in contract. It just takes up a lot of underwriting resources. And most banks still don't have that, and that's why they opt not to do it. Brokers absolutely don't do it, because again, they're not underwriting loans in-house, and wholesale lenders won't just underwrite files that are not actual loans at the time, right? So again, a pre-qual is just, how much do you make, how's your credit, what are you trying to buy, how much money do you have to put down, and telling you, okay, based on that, if this is all accurate and true, this is what we can do for you. They give you a letter that's honestly not worth much. Pre-approval, full review, income, assets, credit. But again, the most important thing that we're doing now is we're taking, once I've reviewed and pre-approved a client, within 24 hours we have that full file through underwriting, so it's a full credit approval. And that's super important.
That is key. So you may have been hit up because you've been renting, and I'm sure I'm not the first person to mail you something to try to talk to you about renting versus buying, and you may get hit up in the mail from people that say, I can approve you, or I can qualify you for X amount of mortgage, right? Based on a few little things. What we're talking about is taking that extra step. So a qualification letter isn't worth its weight in anything. Approval letter is worth its weight in gold, from my standpoint, from most other realtor standpoints. That's how it's going to be worth. Now, a qualification letter is going to take a few minutes to generate from a conversation. Now, the approval letter, it may take a day. It's really relative based on how quickly you can respond to the requests of the lender. So the lender is going to need a day to process. That's not long in today's day and market, and for real estate. A day is nothing if you can get everything together. Now, what I like to do is I keep these checklists on file as well of things that you're going to need to have ready to get your loan approved. So when we talk, I can give you that information so you can start gathering it before we even meet to go show homes or do whatever. You're talking to the lender, and when Ryan sits there and goes, okay, I'm gonna need this, this, and this from you, chances are you're already gonna be in the process of putting that together because I've told you what you need. There may be a couple ancillary things that I don't have on my list that comes up as a course of your conversation, but for the most part, I'll have you ready to go. So we're gonna save some time in that regard, but it's just super important to get a full loan approval, not just a qualification, really before you start. Before you start shopping, because the last thing you want to do is walk into the home of your dreams that you're like, oh my gosh, I can afford it. It's where I want to be for school, for kids, or whatever, and you don't have an approval, and someone else gets that home, and then it's like a dream crushed.
It happens
versus a dream becoming a reality, and that happens.
Putting the cart in front of the horse.
Yeah, exactly.
I mean, you wouldn't go out to a fancy restaurant with no money in your pocket, or if you were on a tight budget, you wouldn't go to a fancy restaurant without at least looking kind of where the prices are at, and if it's affordable and comfortable for you. This is the largest purchase most people make in their life. The biggest debt they're taking on, the biggest purchase. A wonderful way to build wealth for their family, obviously, and we can touch on that in a little bit, but I think it's uber important to be pre-approved in advance, to get financial direction,
Yeah.
to get some professional, strategy and feedback on not just what you qualify for, but what all your different loan options are. Like I talked about earlier, maybe I have a guy that can do 20% down comfortably and they've saved, but they're carrying $30,000 in high revolving debt. I may present an option, hey, we can do the 20% down if that fits you best, but let's look at maybe 15% down.
And pay off that
and
debt.
pay off the debt, and now you can adjust from your $2,500 rent payment to this $2,800 mortgage payment more
Right.
comfortably.
Right.
So my goal is always to give them a good financial strategy to purchase, and sometimes that means the conversation is you're 6 months out. Maybe it's not saving. Maybe we got to work on your credit a little bit.
Right.
It could be a number of things. So that's the place you got to start, is talking to a lender, a broker, bank, whoever it is. You got to start there, I think, before you get out in the field and start shopping and getting your hopes up, because you may qualify for way more than you thought. You may need less down than you thought. You may need time to save. Maybe you've deposited stuff into your account that's going to be an issue for the next 90 days. You're in a cash business, something. So it gives you a jump start to prepare yourself to
Right.
get into the market. Second reason is, it happens all the time. I talked to a client last week. She was rushing to get pre-approved because she found this property she loved, and she wasn't listening to her agent to get pre-approved in advance, and she missed out on it. It happens all the time.
All the time.
In sophisticated buyers to first-time home buyers, and maybe that came off wrong, but somebody that's bought and sold numerous properties, they just assume that they can qualify very quickly, and they don't want to go through these steps in advance. They want to do it right when they find the property, but
inevitably something pops up.
in this market, you have to have your ducks in line. There's too much competition in the market.
Agents today aren't even going to accept your offer
yeah.
without an approval letter, and I can say that hands down. I wouldn't, and I wouldn't even feel comfortable helping you make an offer if you haven't been approved,
Right.
because it just doesn't carry any weight. So.
Yeah. Well, it's supply and demand.
Exactly.
Inventory is much better than this time last year, right?
But it's still not where it needs to be.
No, there's still far more buyers than there are
Absolutely.
properties, so it's competitive, and that's another kind of downfall with some of the big banks, because they've never been real respectful of contract dates. They figure they're lending the money. People can wait until they're ready to fund and approve the loan and all that. They're not involved with the contract, so they don't care about it.
Right.
And so some of them have a bad name on the street, and that reputation, unfortunately, is a disadvantage to a lot of buyers that go in with a Bank of America or Wells pre-approval
Right.
for an agent that's had a very bad experience with them in a previous transaction. And the same thing can be said for the broker channel. The same thing can be said for my channel too. If we have a bad reputation as a lender in the local market, so that this business is very local.
Absolutely.
Word gets around, agents know each other, a lot of us work with each other in different transactions, so that reputation of the bank, the loan officer, the realtor, all that stuff goes a long way for the client. But being prepared in advance so you can act quick and write an offer quickly and confidently, and have all your ducks in line and you're ready to go. And so for my clients that have been all the way through underwriting, when we go into contract, they're literally giving me an updated bank statement and maybe updated pay stubs. The loan's going right back to the same underwriter that did their credit approval initially, picks up where they left off.
Nothing sneaks up on them.
So we're basically, if you look at a loan transaction that we can close in 10 days, as most banks commit to like a 30-day closing. It would
Or
take
45.
or 45. So
it's not uncommon still.
So, something that could take 2 or 3 weeks to get through based on their turn times, we're already there on day one because we've already gotten all that out of the way up front.
Right.
And so it really just, I think the most important thing is just, especially as a first-time home buyer, is just getting educated on what the options are, and then getting some advice on some different strategies that they can consider. There's just so much misconception about credit score requirements, down payment requirements, how the down payment assistance programs work, what's better, FHA versus conventional, and that's the type of information you can get from a professional licensed loan officer, and it's invaluable. And you don't pay for these things. Legally, I don't think anybody can charge application fees.
So used to.
They used to, yeah, absolutely. So we give our service for free to the client, you know, in good faith that we're hoping to earn their business based on the service and the, you know, the service we give them,
Right.
you know, right? The consultation process. So that's super important for me, especially with first-time home buyers. Sitting down once the pre-approval is done and laying everything out, talking about the cost of waiting, doing a rent versus buy analysis, you know, so they can see the potential of long-term net wealth that they can build through home ownership. It is 88% of the wealth in our country is in equity in people's homes. 88%, just read the statistic yesterday, 17% is in the market.
Wow.
Right? So it's a wonderful vehicle to build wealth for your family and your future. We all know that. The tax benefits are huge, you know, and so going through a big consultation analysis of all those different benefits is pretty eye-opening when you compare renting for, you know, the next 5 or 10 years. I can give these projections of where that $2,500 rent will be in 5 or 10 years. How much, you know, equity they would gain just through forecasted appreciation in the market over that 10-year period if they bought. How much equity they're gonna gain just through their amortization, their payment schedule. So every month you're making that $2,800 payment. Progressively, the further you get into the loan, right, with the amortization schedule, you're knocking that principal balance down. So even if the value wasn't to go shooting through the roof, you're still creating an equity position every month. You make your payment, you're creating tax benefit, and just showing them, you know, the possibility over a 5 to 10 year period that you have owning versus renting, and it's very eye-opening for most people, you know.
Yeah, it's fantastic. So, Ryan, I both appreciate you sitting through this long video, and I know it has been long, but hopefully it's been very informational and educational for you. Want to wrap it up by just kind of reiterating what sets us apart from everybody else to, you know, hope that, you know, you find us in your comfort zone to want to work with and want to make an action with. When you work with us, you're working with us. You know, yes, we both have teams working behind us in behind the scenes to make things happen, but 99% of your communication is going to be with us direct. You know, so when you have questions on properties, you're talking to me, or questions on contracts, you're talking to me. When you have questions on your loan, you're talking to Ryan. You know, so just feel secure in that we're not passing you off to somebody else.
Right.
If you decide to click below and submit your name and your phone number and your email for us to contact you, know that it's going to be us contacting you. You're not going to a call center, not selling your information to anybody else. This is private. This is just for us. I don't know if a lot of people are even doing something like this right now, this type of a program, but it's something that I felt in my heart was the right thing to be doing, to really talk to people. So again, you know,
yeah, no, I mean, I'd love to talk to anybody that just wants some feedback, even if it's preliminary questions and a quick conversation. Exactly. Come into my office, meet, see, you know, who you're dealing with, and we can sit down and talk about your goals. I mean, the conversation always starts with the goals.
Exactly.
You know, and then I try to find a solution to meet their goals. And if we can't, then we work together and as a team to nurture clients. I mean, not all of our clients are buying, you know, meeting us today and buying tomorrow. They may be 6 to 12 months out, maybe even longer. And I think having a team, you know, that values your goals and is patient and will work with you to get to your and you know, place, right, is super key. You know, my team, you know, I've been in the business 20 years. I have a small team, big enough to service my clients well enough, but I've never wanted it to, you know, be that I'm passing my client off to somebody else on the team. If they're referred to me through an agent I work with or a past client or whatever the case is, I want them to get that one-on-one with me from start to finish. Now my team's there to help with some of the minutia to keep things moving on the back end, and they do insert themselves a little bit into the transactions, you know. But at the end of the day, I'm the one at the helm, right? Yeah. And then our teamwork, I think, goes a long way, Ron. Just in transaction, there's so many moving parts, and just having an agent and a realtor that have a good relationship and that honesty and that track record together is, I think, super beneficial for all parties in the transaction. And you know, we can take a lot of that pressure and that emotion and angst off of the buyers
Right.
back. You know, I think because we know each other and there is that level of trust and we can work well together in the benefit of the client.
Absolutely.
Right.
So, hopefully you're ready to take action today. Like Ryan was saying, you might not be ready to buy it for 6 months or 12 months, but the time is now. It's today to actually figure out what your timeline's going to be. Hopefully that makes sense to you. If you wait 6 or 12 months to even decide that you want to go down this path, well, you might still be another 6 or 12 months down the road because you weren't prepared. You weren't set up for success.
Right.
We want to just help you get you set up for success. If that means you take action today and we find out you're ready to buy today, great. If you take action today, but you need a 6 to 12 month plan to get there, well, you're ahead of the game still.
Right.
Waiting 6 to 12 months to then come back and take action, you might be told it's going to be another 6 to
And
12
then
months,
just-
and you just never know what's going to happen with the market at that point.
Right.
And everything else. So.
Well, yeah, I mean, next year values will certainly probably be higher than they are now,
Yeah.
and rates could be higher. So there is definitely a serious cost of waiting that is real. But you'd be surprised. I talked to a lot of folks that have been apprehensive of taking the steps just because they think it's going to be too encumbering or take too much time. With the technology out there, my clients especially, millennials that are very good with the technology, it's a click of a button. They have me all their stuff in seconds. I mean, we can go out and grab tax returns electronically, or W-2s, whatever we need. We can grab a lot of that where they don't even have to provide it for us. They just have to authorize us to do it.
Got it.
So we leverage the technology. Some clients, are a little more old-fashioned, want to come in the office with stuff, but it's not as daunting as I think a lot of people think. And what's funny is it can be just the opposite of trying to prepare. I've talked to so many clients that have been preparing the wrong way because they didn't get the right advice, and they're still thinking they got to put 20% down. And now they've let that $500,000 home go up to $570,000 because they've been on the sidelines for a year and a half saving.
Right.
When they just didn't get the advice that they could do a 5% down and qualify and meet their payment goals.
Or they thought that down payment was their issue, but credit was actually their issue.
I mean, it
Or
could be
their
a
debt to
number of
income was
things,
their
right.
issue, or they thought, or their credit's great, but their debt to income was screwed up, and they were working the opposite of what they really need to be doing. So basically, what we're saying is don't hesitate to start today, going down that path. So again, name, email, phone number. We'll get with you. We don't sell your information to anybody else. You'll just be dealing with us, and we really look forward to working with you. Thank you for hanging out with us.
Thanks so much.